How's it, guys? Welcome back to another video. Today's video is about simplifying ICT market structure. We are going to go over the 3 steps that I use to simplify ICT market structure and increase my win rate in the market. The steps that I use are the basic structure, which is step number 1. Step number 2 is our impulses, and step number 3 is high is always bad. I'll go in detail about every step here. So before going into the video itself, please hit that subscribe button, like, share, and comment on this video, guys. And please stick to the end because I will reveal the best time frames that I use that works for me always. 90% win rate when I use these time frames. Okay, now let's go to the video. Okay, guys, the first thing to simplify ICT market structure is to go back to the basic. And the basic structure has 2 core fundamentals in it, which is our highs and low and our discount and premium. Now let's go through this concept in details, right? Let's start with the highs and low first. Like I said, the first basic is your highs and low. You must learn to instinctively plot out your highs and lows without going very far back on the market. So you need to focus on the month that you're in, the week that you're in, the day that you're in, or the session that you are trading, right? So to do this, look at any swing low or swing highs you can see in the market and plot them. Don't pay much attention to what low made a high or what high made a low. So if you look at your screen here, you realize that we have this high here and we have this low here. So let's use this as our first low because we don't want to go far back in order to trade today's candle, right? So we have this low and the market made this high, right? It's not a high. It's not a high because it's still lower than this one. But the market made a low, which is a lower high. It's a lower high because it's higher than the first low. Then after that, the market made a high by breaking both of these highs, right? So we have a higher high, then we have a lower high, a higher high, a lower high. So now we can see from this basic structure here that we are in a bullish trend, meaning that the market is going up, right? The market, when it's bullish, is characterized by the market making a series of high highs and higher lows, right? If it was going bearish, it was going to be the opposite of that. We're going to experience lower lows and lower highs, right? So that is your first basic. Your second basic is your premium and discount. What do I mean by premium and discount? I've already talked about this many times on this channel, that premium and discounts is the most powerful ICT concept that you can utilize and include in your trading, because premium and discount dictate to us where we are going to buy and where we are going to sell, because we do not just buy or sell the market. We want to sell when the market is in a premium and sell and buy when the market is in a discount. Okay, guys, in order for you to get your premium and discount, you first put your fib at the low and the high. So this is going to be your low and this is going to be your high. Do it for all the lows and highs. Okay, guys, when you have it like this is your equilibrium, which means the middle part of your expansion or your expansion leg, right? So everything below this equilibrium is your discounted market, and everything above this equilibrium is your premium market. So this is where you want to sell. You have to wait for the market to get into this discounted market so that you can buy, or the market get into a premium market so that you can sell. So let's look at this example let's use this example here. This is your equilibrium. This is your this is your equilibrium. This is your premium market, and this is your discount market. So for you, in order to buy, you have to look at your PD arrays in your discounted market. So we have this propulsion block, we have this fair value gap, and we also have this fair value gap here. So if you were to take a trade, where were you going to take your trade? You were going to wait for the market to go into a discounted market so that you can buy. So your position on a daily time frame is going to be something like this at the 50%, because the 50% is your equilibrium. Anything above here is your discounted. So if you want to put it like this, then you have to put your stop loss below this low, and this is going to be a very long stop loss. So where's your target? You target your high here. Why? Because the next target is our draw on liquidity, because the market is bullish, meaning that the market is breaking the highs and keeping the lows. So if the market comes below this low, we expect a change in a state of delivery, meaning we expect the market to go bearish and no longer bullish, right? So you buy at the 50% here, where 2 things that I have to emphasize. You must look for your PD arrays in a discounted market, because premium and discount tells us 2 things. You need to know how to buy the market and where to buy the market. If you want to know how to buy the market, there are other entry triggers or entry method that I've discussed in this channel. Go watch those videos. But The second leg of this, you know where to buy is you buy in a discounted market and you sell in a premium market, right? So you target this high. So when you target this high, this is not your entire trade. You can target this high, and when the market comes here, you take your partials and you move your stop loss to this low because the market is unlikely to go back to this low, and you target higher. Keep on increasing your target and increasing your stop loss, putting your stop loss in profit and taking partials until you get stop out in the market with profit while you already took out your partials. Okay, so that is your first. That is step one, which is highs and lows and discount and premium. Highs and lows just simply means that we know the direction of the market. When the market is breaking the highs, that means the market is bullish. When the market is breaking the lows, that means the market is bearish. When the market is it's not breaking the high and it's not breaking the low, then the market is ranging, it's moving sideways. Now let's go to the second step. Step number two is how to draw impulses. Right? What do I mean how to draw impulses? Because the market moves in an impulsive stage. You have a low and you have a high. So from the low to the high, that's an impulse, right? So this is important because in order to have a clear market structure, we must see impulses and displacement, which is a big and obvious push throughout structure, right? So impulses have two rules. We have, how to draw impulses have two rules. You have to focus on the impulse itself, and number two, you have to focus on the displacement. Let's go to the market and look at an example of this. Okay, guys, with the practical example of our impulses, we have this is our first step, right? The first step was highs and lows, high, low and high, low and high. So the second step is you must have impulses. Impulses means the move up. So from this low to this high, this is our impulse. This is our impulse from this low to this high. So in order to discuss the two rules of impulses, the first one was we need to see the candle closure above a certain high. So we have this high here, which we have this candle here, which closed above this low, right? So this is our candle closure. So this is the first rule. The second rule is we must see displacement continuing to the upside. So what does that mean? This is not only enough for the market to close above this high. We need to see the market continuously pushing above this structure up so that we know that this is a proper displacement, that when we see a proper displacement, we know that the market is going up now, right? But the market cannot go up forever because the market has to retrace back into a discounted market so that buyers can buy in a discounted market and ride with the market up. So the market closes above this high, then we see the second candle, we see our displacement going further up, we see a small candle retracement, then we see another bullish candles up, right? So whenever we see this, we know that our structure is valid. The market, the algorithm is pricing price higher. So this is a valid bullish structure, right? So the first rule is candle closure, and the second rule is impulses above that candle closure. Okay, now let's go to step three. Okay, guys, the last step, which is step number three, is higher is always better. What do I mean by this? This means that no matter where you get your entries, whether you get your entries on the 1 minute, the 5 minutes, or of the fifth or the 15 minutes time frame, always consider the bias of the higher time frame. This is so because higher time frame bias is a lot stronger than a 1 minute bias, right? So if you are trading on the 1 minute time frame, always look at what the 1 hour time frame is doing and what the daily time frame is doing, right? So if you are bullish on the daily time frame, you cannot be bearish on the 1 hour time frame because the 1 hour time frame will always follow what the daily time frame is doing. So if we're retracing on the daily time frame to go into a discounted price so that we can buy, the market structure on the 1 hour time frame will be something like bearish until we reach the discount price of the daily time frame, right? So when we get to the daily time frame discount, then the market on the 1 hour time frame is going to change direction. Okay, what do I mean by that? Let's go to the chart and look at the example of that. Okay, guys, here I zoomed out. If you can see, this is the this is the low of the daily time frame, and this is the high of the daily time frame. This is the low of the daily time frame, this is the high of the daily time frame. But if you can look at this on the 1 hour time frame, we have a clear market structure which is bullish on the daily time frame. But on the 1 hour, you have something like this, right? Let me use this one. We have something like this. From this high to this, from this low to this high. That means we broke this high. Now the market we know that is bullish on the daily time frame. But what happens on the 1 hour time frame? On the 1 hour time frame, we have a break of structure to the downside. We have the market going below this low here. So whenever this happens, this is your changing the state of delivery. We have a market structure shift here. We have a break of structure to the downside from this low here, but this is just a break of structure. So this will become our market structure shift. So when on the hour time frame, you can see that from here to here, we've been bearish because the market broke this low again, then broke this low and broke this low, but it didn't break this low, right? Oh, it also did break this low, but it didn't break the daily low because this is the daily low. So on the 1 hour time frame, the market is from here to here is bearish, but on the daily time frame, this is only a retracement for the market to go higher. So even if you can realize the market came and made this low and made almost equal lows here, then the market went up and tapped into this fair value gap here, or the order block here, tapped into this order block here, then went down again. But when it was going down, it didn't break this low, because this is, if it breaks this low, we are going to experience a change in the state of delivery on the one daily time frame. But on the 1 hour time frame, the market should not go below this low. So the market must keep on making higher highs and higher lows, right? So this is now becomes our low, because why? Because the market came into a discounted price on the 1 hour time frame, sorry, on the daily time frame. To look at that is look, go back to the daily, and this is where the market went. The market went to an order block on the daily time frame. It went to the order block, tap the order block, and continue going up. It didn't break that structure. Let's go to the 1 hour and see that. This is the daily low, and this is the daily order block. So if you were trending counter trend line, you're going to wait for the market to hit the 1 hour order block here, take out your short position here, and where you're going to target if you're trading counter trend line. You're going to target this order block, which is in a discounted market, right? And you hide your stop loss above this high. So this is going to be a trade when you are trading counter trend line. But if you are trading with the trend of the daily time frame, which is bullish, you're going to wait for the market to displace above this high here. Let me remove this, to displace above this high here and get your end. But this here on the 1 hour, the market just kept on going up. So you have to go to the lower time frame. Let's go to the 5 minutes. This is the daily order block. And on the 5 minute, we have the market going below above these highs here. When the market went above this high, it left fair value gaps. The first one is here. So when the market was going back, going back bullish after hitting the daily time frame order block, the market left these three order blocks here. So you need to find your discount and premium. This is your discount, this is your range, right? So every order block is in your discounted market, with the inclusion of this one at the 50%. So the most likely trade is going to be on this fair value gap and this fair value gap. So you take out your buy position, buy here, and put your stop loss below this low, because you already tapped into the daily order block. Then you're going to target what? The daily high, which is here. This is the daily high. You can target. No, this is the 1 hour high. So the daily high is a lot higher than that one. The daily high is here. So this is going to be, because the daily high will act as your draw on liquidity. So this is going to be your complete trade. Okay, guys. Now for the time frames that I use. I use the weekly time frame for buyers. I use the daily time frame for liquidity, which is our liquidity, draw on liquidity. Then I use the 1 hour time frame for structure. Then I use the 15-minute time frame as further intraday liquidity. Then I use the 1 minute, the 1 minute and the 5 minutes for entry. Those are the time frame that I use. Okay, guys, I'm going to stop the video here so it doesn't become unnecessarily long. So if you have enjoyed this video, please consider subscribing, liking, and commenting on this video. Hit that subscribe button, guys. Let's get to 1,000 subscribers by the end of this month. Let's go. Peace out.